Hey, good morning, everybody, and welcome to this. What do we got? Tuesday, October 21st, 2025 edition of Trading Places Live here at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist at Earnings Beats. Pleasure to be with all of you again this morning. Overall, market continues to do its thing. Just keeps trying to go higher. We're trying to get some all-time highs yesterday. I think on a closing basis, I think the S&P 500 made it by about a point or something. I know it was really close. I didn't go back and look, but I know we were really close there. I think same thing goes for the NASDAQ. Small caps a little bit off of their all-time highs, but a nice day in the small caps as well. So, we're getting ready to start the worst week of the year historically. And we talked about this a little bit last night. We had our model ETF draft. So that's an event that we have every quarter where we try to outperform the S&P 500 by rebalancing the sector ETFs. And we did it for the second time in a row. We've only done it twice, so we're 2 for 2. And we're going to try and do it again for the third quarter. Made a couple changes, which I thought were kind of different. We're going to actually have a kind of a redraft in the middle of the quarter based on some of the historical tendencies. But really, it's just trying to, tweak the percentages of each of the key ETFs that make up the S&P 500, all of the different sectors, and just try to weight them differently to take advantage of technical strength or seasonal strength. And we'll see how we do. But again, last night we did that, and we talked about this upcoming period, and we talked about the overall seasonality for the next 90 days or so, and how historically this is a really, really bullish period. But we do have to get through this next week. So the October 21st close, which is today, so today's close through the October 27th close, historically has been the worst week of the year since 1950 on the S&P 500 and across the other major indices as well. Now, don't take that quite so literal. We're not talking about the market collapsing every year this week. The annualized return for the week is, I believe, minus 45%. And so, roughly that's, close to 1% per week. Because remember, when you're interpolating it, when you're making it annualized, you're taking the information for a week, the average, gain or loss for a week, and then you're interpolating that over the course of a year. And so the actual loss, the absolute loss, is less than 1% on average over the last 75 years. So you're talking about, 60, maybe 50 or 60 points on the S&P 500. That would be the average. Now I talked about, I think there was, trying to think, over the last 75, I believe it was 31 times that this period has gone higher and 45 times that it's gone lower. So it's about a 60%. It's like 3 out of 5 years will go down this period. 2 of the 5 go up. So, it's not a slam dunk that the market's going down. I don't want anybody to misinterpret what I'm saying. It's just that seasonally, the tendency is that the market goes down more often this upcoming week than it does any other week throughout the year. Any consecutive, and this is actually 6 days, so it's just shy of a week. But this is the worst 6 consecutive day period of the year. So take it for what it is and for what it's worth and for what it means to you. But longer term, it means nothing. Short term, for a trader, if we see a little sideways action, don't be shocked. That's all. All right, let's move on and take a look at what happened yesterday and what we might be looking at today. But first, we will check out the market overview section here. Let me just make that a little bit bigger for you so you can kind of get a good sense of what's going on there. You can see the Dow Jones Industrial Average up over 500 points yesterday, 1.12%, now approaching 47,000. The S&P 500 up 71, 67.35. That was a little bit more than a 1% gain yesterday. The NASDAQ, 22,990. That was a 310 point gain, or 1.37%. slide down here to the S&P 600 small cap index, which gained almost 1.6%. And the VIX, notice the VIX dropping more than 2.5 points or 12% back to 18.23, but it's still in that 17 to 20 range. So I don't feel like the move to the upside, is necessarily over in terms of the VIX, which means that the move to the downside in stocks may not be over. And again, I just say may because of this historical week coming up. Outside of, the seasonality, I mean, it's hard not to like what the market's doing. We were led again by technology stocks. I can zero in, show you how we do that stock charts here on the dashboard under member tools. You can just slide down until you get to, actually, I think I passed it. There it is. Under research tools, the sector drill down. So you pull that up. You can take a quick look at what was leading the action yesterday. A bunch of sectors were up over 1%. 8 of the 11 were up more than 1%. So it was a pretty broad advance to the upside. And materials leading at 1.19%. But then in the 8th spot was real estate at 1.05%. So 8 groups were pretty darn close in terms of leading this to the upside. Industrials and financials kind of trying to reclaim their leadership role. They tend to lead this time of the year, October, November, especially for industrials. And same goes for financials. Communication services, technology, all of these groups, these are 4 of the 5 aggressive groups, all among those 8 that were leading. So it was pretty good action to the upside. And even among the consumer stocks, consumer discretionary wasn't up 1%, but it was up 0.8%. Meanwhile, staples down 0.1%. If there's been one area of the market that's maybe been just a little bit concerning, or maybe a second area, I'd say transports are the one area. But if there's been another relationship, if you will, that's been a little, maybe just a little wonky, I would say it's been consumer discretionary versus consumer staples, where we've actually seen discretionary pulling back relative to staples. And that was fine when the market was pulling back. That's kind of a normal thing. But the market now has rallied back and trying to break out again. And we really haven't seen a whole lot of strength coming back into the discretionary area yet. So again, if there's one area maybe to kind of keep an eye on, that would be it. But the other side, I would say, if I was arguing it on the other side, I'd say it really doesn't matter as much because the fourth quarter tends to favor more dividend-oriented, value-oriented type stocks. So kind of what discretionary is doing is what it tends to do most years. So maybe there's not a whole lot to worry about there, but it is something. It's one of my biggest intermarket relationships or ratios that I like to follow. And so certainly something I'll keep my eye on. S&P 500, here was that rally yesterday. The other thing that I liked about yesterday's rally is it was kind of a trend day. It didn't gain a lot, so maybe I wouldn't call it a trend day, but a trend day is where you open and you just go up all day long, just a straight move up. You tend to have a little bit bigger gain than just 1% on what I would call a trend day. But it would look a little bit more like this red-filled candle, except it would be a hollow one going to the upside. But still, it was mostly strength throughout the day. If you look at the intraday chart here, we opened up a little bit on the S&P 500. We rose throughout the morning. And then maybe you could say we went mostly sideways. But the point here is, unlike the last several days, there really was no period of selling. Probably the biggest selling occurred in the last 10 minutes into the close. So not a whole lot really to dislike there. I think the action was pretty good. Here was the NASDAQ also. You can see moving up, getting very close to this breakout to an all-time high. Maybe we can get that today. We do have some big earnings reports coming out. We've kind of gotten through most of the large money center banks. So now we're seeing a lot more of the mid-tier to even smaller banks that will be reporting over the next couple of weeks. And now we're going to start seeing some of the bigger names, some of the Mag 7 type stocks, or maybe stocks that are just outside the Mag 7. So the first one will be this evening. We have Netflix reporting after the bell today. Tesla reports, I believe it's tomorrow, but maybe it's Thursday. I have to go back and double check that. Make sure you double check if that's important to you. But both of those companies reporting this week, and then next week we'll start getting into more of the Mag 7, some more of the large cap tech names, and that's going to help determine where we're going in the market. There's no doubt about it. Earnings and interest rates drive the market. Interest rates are coming down. The Fed is essentially promising, talking about continuing to cut rates. I think we're going to see 2 more rate cuts this year, and I think at least another 2 or 3 next year. That's my prediction. And so valuations, if nothing else changes, valuations will go up because interest rates come down. That's the way it works. Future earnings become much more valuable in a lower interest rate environment. So we've got that going for us. And now we're going to see whether or not these companies can deliver earnings. Companies that have operational efficiencies, many of the large cap, the Mag 7s, I would say they are probably among the best in terms of operational efficiencies. They're going to report strong numbers. And when you're reporting stronger numbers in an environment where rates are coming down, that is nirvana for valuations. So we're going to see some big moves in individual stocks. And I believe the overall market is going to go up as a result of rates coming down and earnings going up. And future earnings expected to continue to go up because of the lower rates and because of the impact that will have on the economy going forward. So personally, when you've got strong earnings and you got rates dropping, that is nirvana for stocks. Very difficult to be bearish with this backdrop. All right, small caps. IWM, another really solid day yesterday. We continue in this uptrend. Last Friday seems to be last Friday, history at this point. The S&P and the NASDAQ trying to get back through that high. But here on the IWM, you can see that high was already made, or at least getting back up above that range that we were in last Friday. So we've already cleared that, trying to move back up to another all-time high on the IWM. All right, moving on to the transports. Transports, you can see going sideways. We did have a pretty good day yesterday, gaining almost 1%, lagging the major indices, but still up is up. Always nice to see, especially in a group that has not been performing very well. But as you can see on the chart, there's still a lot to do from an overhead perspective. We got the recent high up near 16,000. That would be the first step to clear. Then if you go back a couple months, you'll see right about 16.2 is another level. Then we've got a double top at 16.5. And that's not even taking into account some of the highs from, prior. If we pull up a longer term 5-year weekly chart, we have the high from November of last year, which is up near 18,000, just shy of that. And then we have an intraday move back in early November of 2021, where we made a big move up through 18,000. So I would say getting a close above 18,000 ultimately is what we want to see out of transports. But we're sitting at 15.8, and we've got short-term concerns that we need to get through first. I know a lot of folks remain concerned about the transports. I'm one of them. I will say, however, though, if you look at this long-term, we are still in an uptrend on the transports. It doesn't feel like it because the last 3-4 years have been consolidation. But normally after you go through a lengthy period of consolidation, when you do finally break out, it can be a very big move to the upside. And knowing that the Fed is now turned and looking more toward the economy, lowering rates, trying to spur the economy, trying to avoid a recession. I think that kind of backdrop from the Fed will likely, at least in time, will likely help the transports and may forge that breakout. Maybe it'll be later this quarter. Maybe it'll be in 2026, but I do think it's coming. All right, for those of you who are new to Earnings Beats, just want to make sure you're aware, go over to earningsbeats.com. A couple things I always like to point out. First, you can start a no-cost 30-day trial just by clicking that green button. We got a lot of things coming up here over the next month or so. We're within a month now of doing our next portfolio draft for our stocks. Right now, we're beating the S&P 500 again on both our model portfolio and our aggressive portfolio. And we've crushed the S&P over time since the beginning of both those portfolios. But if you want to be a part of the next draft, you can sign up now in your 30-day free trial. We'll cover that. So good time to sign up there. Also, if you just want to learn more about us, right here, you can sign up for our free EB Digest newsletter. This requires no credit card. We've had literally tens of thousands of folks join us for this newsletter. Why wouldn't you? It's educational. I think there's a tremendous amount of value in it. Name and email address is all it takes. We'll send out the newsletter to you on Monday and Wednesday. And when I say newsletter, it's very loosely newsletter. It's 2 paragraphs and a chart. It's a very simple read, and it keeps you up to date on things that you need to know in terms of what's been going on in the market and that sort of thing. So anyhow, I think it's a great add-on. If it's something you want to learn more about technical analysis or the way we approach things at Earnings Beats, that's probably your first avenue. Name, email address, hit that subscribe button. All right, down here you can click on the historical performance and get a general sense of what we've been doing here. Again, through yesterday, this quarter, meaning from August 19th through November 19th. Of course, like I said, we're October 21st, so we're within a month of the end of the quarter. But right now you can see the model portfolio, which is our flagship, gaining 9.16% for this quarter since August 19th. The S&P 500, by contrast there, gaining a little over 5%. So almost a double this quarter on the model portfolio. Aggressive, a little closer, but also slight advantage, gaining 6.4% versus 5%. And if you join, you can find out what stocks we have in both of those portfolios right now. I think some of these stocks are getting set to go on a big move to the upside with earnings coming out. So you join, you get a chance to see what those stocks are and maybe participate in some of those runs. Anyhow, let's keep moving. So I wanted to show you, I mentioned the EB Digest. Here was one of the stocks, Applied Materials, that we featured right about in here. I think it was right after we moved through the 20-day moving average and pulled back. I think it was this day. I think it was for Monday, September 15th. That would have been the EB Digest. But this is one we liked. We said it was early. I'm going to annotate this because I want to just kind of show you. So if you look, I'll show you on a longer term chart in a second, but that essentially is a neckline where you got the left shoulder over here. You bounce up to the left side of the neckline. You come down to the inverse or reverse head, come back up to the right side of the neckline, then put in a right shoulder. And then this move back through the 20-day. That was kind of maybe an early signal. There's no guarantee we were going to make this breakout, but we're in a secular bull market. So I'm not expecting stocks to languish. I'm expecting stocks, especially stocks that have long-term bullish track records, to start to turn bullish again. So Applied Materials on this move back through the 20 started to look interesting because this was almost a perfectly symmetrical bottoming reverse head and shoulder pattern. And a breakout above 200, I said this when it was at 168, I said a breakout above 200 would actually measure up from 200 down to about 120, which is 80 points. That takes you to 280 on a measurement, and we were trading at 168. So it was certainly worth considering given the potential reward to the upside versus the risk to the downside. And shortly thereafter, it was only about 2 weeks later, Applied Materials makes this breakout now at 230. I think its all-time highs around 260. And this target on this breakout is 280. So Applied Materials, I think, still has a much longer way to go. Maybe we sideways consolidate for a period of time because as we're breaking out here, you can see there is a negative divergence. So we might have to kind of have a little patience here. But otherwise, Applied Materials looks really good. Now, let me get out of the annotation here. Let me show you the longer term chart. So you can see a weekly chart. And here you can see the pattern maybe a little bit better. So you got an uptrend. You come down into this left shoulder. You move back up into the neckline, back down into the reverse head, back up to the neckline, then back down to the right shoulder, and then out you go to the upside. So the chart looks really good. I think this pattern is very easy to recognize. And like I said, that measurement is 80 points up to 280. Pretty exciting stuff for Applied Materials. And while I'm on the subject, if we go to seasonality, let me show you semiconductors and how they tend to perform since 2013, since we started this secular bull market. Look at the November performance of semiconductors. 92% of Novembers have gone higher since 2013. So that tells me that essentially it's 12 of the last 13 or 11 of the last 12, since we haven't had 2025 yet. So 11 of the last 12 years in November, semiconductors have gone higher, and they've averaged going up 7.5%. That's pretty impressive. And if you look at it versus the S&P 500, we go back 13 years, you'll see that the semiconductors have outperformed the S&P 500 2/3 of November's, and to the tune of an average of 3.5%. The only other month of the year that is better in terms of semiconductors' relative performance is in May. So November, very, very strong month. Here we are, it's October 21st. So in 10 days, we're going to be moving into one of the best periods of the year for semiconductors. I expect their earnings are going to be strong. And one stock I'll tell you right now that loves the month of November is NVIDIA. So if we pull up NVIDIA, you can see the last 5 years, it's been up, 6 years, 7 years. Last 7 years in a row, it's been up in November. And if we go back to 13 years, you'll see 83%. So that's going to be what, out of the last 12, it'll be 10. 10 of the last 12 years, NVIDIA has been higher, and the average gain has been 9.6%. Again, the only month better for NVIDIA has been May, where it's gone up 92%. So it's gone up actually 11 of the last 13 or 12 of the last 13 years and averaged 14%. But there's a lot of semiconductors that love the month of November. And like I said, the overall group loves November. So something to think about as we go forward. Many of the aggressive areas, actually the overall market just loves the month of November. So let's pull up the S&P and look at this seasonally. Go back to 13 years. And again, I'm stopping in 13. I'll show you a long-term chart of the S&P in just a minute. But the reason I go back to 2013 is because to me, that's when this secular bull market was confirmed. And so if we're still in a secular bull market, I want to know how these different areas perform during the secular bull market. If we throw a secular bear market into it, like we go back 20 years, then you're starting to mix how an aggressive group like semiconductors does during a bear market, which doesn't make a whole lot of sense. But anyway, so that's the reason for the 13 years. But anyway, S&P 500 right here, you can see over the last 12 years, 11 times we have been higher. So that's 92% of Novembers have gone higher. It's the same as July and May. So May, July, and November have been the best in terms of the odds of a particular calendar month going higher. And then if we look at the actual average returns down here at the bottom, make that a little bit bigger so you can see this. Look at November, 3.9% average return in November. And you go across the bottom here, July's 3%. Nothing else is above 1.5%. So outside of July, November is almost 3 times better, than any other month. Pretty bullish stuff. And so when I talk about wanting to be long in the fourth quarter, that's a big part of it. November is such a strong month. It has been such a strong month. Could it go down? Of course it could go down. I'm not saying it can't go down, but history tells us that the odds are in our favor. So let me show you this S&P 500 chart. We can go back a ways. But first of all, I mean, you can see the move here. off the 2009 low. And you say, well, why don't you go back 16 years? I could. What I ended up doing was, actually, let's change this to 25 years, or let's actually go 50 years. So April of 2013, right here, you see the double top that took place on the S&P 500. This was around 1550. I think this was also around the same level, or maybe one was 1530 and the other one was 1550. When we finally definitively went above, closed above both of these highs, I believe it was April 10th, 2013. And since that time, that confirmed that we were in a bull market. Otherwise, you could have said this was a bull market, right? Coming off this low. Why wasn't that part of the long-term secular bull market? Well, we never got the breakout. And then we went back down and put in a lower low. So right there, that confirms we're still in the secular bear market. So yes, the bull market, you can argue, started in 2009, but it wasn't confirmed until 2013. That's when you got the breakout. That's what you needed to confirm that you're now back in an uptrend. And so that's when we confirmed that the secular bull market was well underway again. All right, next thing I want to do, I want to bring up a couple of these momentum chart lists that we like to do every week at Earnings Beat. So I'm going to start off first with the leading stocks and leading industry groups. So in this particular chart list, what I like to do is go back, take a look at all the areas that I think are performing pretty well or are strengthening, really starting to show some strength. And from there, pull up all the stocks that have scooter scores above 95 and are on one of our key chart lists. It's either got to be on our strong earnings chart list, strong future earnings chart list, raised guidance chart list, or strong AD, accumulation distribution. If it's on any of those 4 chart lists and it's in any of the industry groups that I suggest are strong, and it has a scooter score, stock charts technical rank, it's a relative strength indicator. Any scooter score above 95, it gets added to this list. So when you look at this list, it's a pretty all-encompassing list of some of the best stocks in leading stocks and leading industry groups. And that's what we talk about at Earnings Beats all the time. That's really the types of stocks that we want to trade. So when we pull this up on the leaderboard, summary leaderboard, you can see from yesterday, here are how these stocks performed yesterday. And I can put in the sector and industry group. Some of these biotech stocks are just exploding. So I added biotech recently, and look at all the biotech stocks near the top of this list. The biotechs are absolutely exploding to the upside. So a lot of these stocks are biotech stocks, but we can sort it industry group, and you can see. So here's aerospace. So now if I sort it by change, percentage change, and then I sort it by industry group, it'll give me the percentage change by industry group. So I've got 3 aerospace stocks. Here's how they all 3 performed yesterday. So here's all the biotech stocks, a lot of biotech. There were a few that were down, but you can see a number of these stocks making huge moves to the upside. And then we can go on and look at some other areas. Coal's been hot. Computer hardware has been hot, but yesterday computer hardware was not. So this is maybe an area, some of these stocks pulling back might be presenting some short-term opportunities. That's the way I would look at it. And then we can just kind of go down through. I was going to go to the semiconductors. So here's our list of semiconductors. Navitas, which is on our short squeeze chart list as well. It's a heavily shorted stock. And VTS gaining 16% yesterday. SanDisk, Laser, this Enlight. This is, I can tell you, one of our portfolio stocks. Big day yesterday, gaining over 5.5%. AMD continues its move to the upside. Then we've got software stocks. You can see some of these software. This is a stock I mentioned not too long ago, maybe in the trading room a few weeks ago, CLSK, or maybe it was an EB Digest chart. I can't remember when I talked about it, but this thing has been on a roll. Moved above 20 yesterday, gaining 88 cents, 4.5%. Porch is one that I've been looking at recently. I think this is one that could make a pretty serious run. and it's up 4%, probably just starting a bigger run. Anyway, this is a great list to work off of to trade. And I want to mention one other, because our very own Matt Townsend, he's been keeping his own hot stocks list for a long time, and it's done very well. And so we talked about it, brought it up in the live trading room a few times, and members really wanted to see it. So we've started, providing that for everybody. So Matt looks at this. He looks at the top groups and then picks some of his favorite stocks. He caps it at 20 stocks every week. I think the one that I did, the leading stocks and leading industry groups, is closer to like 100 stocks in there right now. So if you want a little bit more narrow focused group, then maybe take a look at something like the hot stocks. You can see here a few of the stocks doing really well yesterday, getting off to a pretty good start this week. But anyway, check those out. Anyhow, it is 9:30. That's about what I wanted to go over today. So let's check out what's going on. The Dow Jones opening up 60 points. NASDAQ down 13. Small caps down a little bit. So a little bifurcated action. Some up, some down here at the opening bell. Again, we've got Netflix reporting after the bell today. Tesla later this week. And the number of companies that are going to be reporting are only going to escalate from this point forward. So anyhow, be careful out there, especially over the course of the next week. Worst week of the year historically. Again, not looking for a collapse or anything like that, but sideways action wouldn't surprise me. It also, quite honestly, would not surprise me if we went up every day of the next week and just set new all-time highs, because that's what happens in secular bull markets. But I do want to point out that, this isn't my opinion. It's factual. This next week, starting today at the close through next Monday's close, is the worst week of the year historically. So keep that in mind. Anyway, have a great rest of your day, everybody. I'll be back tomorrow morning, 10 a.m. for our live trading room. Take us up on that 30-day free trial offer and join us in the trading room tomorrow. And also, you'll get the stock portfolios in 30 days when we update those. So you'll have those for the next 90 days. Great time to join. Click that like button if you can. That certainly would help us with the YouTube algorithm. We're trying to build the community here on YouTube. Also, subscribe to our channel. We do free live stream events from time to time. And if you're subscribed and you turn your notifications on, when we start one of those events, you'll be notified and you can join us. So anyway, have a great rest of your day, everybody. Happy trading.